right, good afternoon, financial advisors and professionals. Welcome to The Brew. My name is John Florence, and I am the Vice President of Marketing here at E4 Insurance Services. I'd like to welcome you to our weekly Brewcast, building relationships every week. Thanks for tuning in today, and for those of you who are joining us for the first time, we'd like to start this broadcast by celebrating today's National Day. There's three of them that I'll focus on. First of all, today is National Vietnam War Veterans Day. So special hats off and thank you to those of you who served in that conflict. And we thank you for your service there. Also today is National Lemon Chiffon Cake, which happens to be my personal favorite kind of cake. So if you get an opportunity, take a bite of that tangy sweetness. And then lastly, today is National Mom and Pop Business Owners Day. That might have a little bit of applicability to our topic on the brew today. So take an opportunity and go out and support those small businesses in your community and help those business owners along. On today's brew, we welcome back Dave Soczek, who is the owner and vice president at National Benefits Group. For our regular attendees, you may recall that Dave gave us a presentation a few months ago about non-qualified defined benefit plans. And if it's a new topic to you, we invite you to view that brew episode, and you can find that on our YouTube channel or on the E4 website under the brew tab. Today, Dave is going to take a bit of a deeper dive on the subject, and we're going to particularly have him talk to us about a typical case example that you might encounter as an advisor throughout your career with your various clients. So Dave's going to jump into that a little bit more detail. Dave, welcome to the brew again. And why don't we start off by telling us a little bit about National Benefits Group, remind folks what you do, and then also remind us a little bit about those opportunities that you see in the defined benefit plan space.
All right, while doing that, I will pop up my presentation and just kind of have that ready for us. There we go. And John, let me know if you can see it. If you can, then I will answer those questions. So thank you. Yeah, so in regards to National Benefits Group, really what our firm has done really for the last 50 plus years is work with producers and advisors in helping them with advanced solutions for executive benefits, non-qualified plans, the topics that John had mentioned. Also trying to figure out different ways of being able to use corporate assets with life insurance solutions, such as bank-owned life insurance and corporate-owned life insurance. So our goal is to help producers, and in turn, helping producers help their clients be able to solve inefficiencies in other types of plans that they do. And really, that's really what we're going to talk about today in one specific type of plan in regards to supplemental executive employment or executive benefit plans. We're going to talk about defined benefit programs. But before we even get there, we want to just kind of recap a little bit about what supplemental employee benefit plans or executive benefits are. And they're really programs, you know, as John, you mentioned mom and pops, but businesses of all sizes, from, you know, the smallest businesses to Fortune 500. Everyone wants to try to recruit, reward, and retain their key employees. And a lot of times the traditional benefit plans that are put in place, group benefit plans, 401k, great programs, but unfortunately they don't always meet the needs of ownership or key individuals. And that's where we come in, and you come in as well, is trying to figure out how we can help those businesses when they've maximized or capped out of their traditional benefit programs. And that's when supplemental programs come in place. You know, really what they're trying to do is you want to create something for 1 or 2 people, 10 people, 15 people, but at the same time, you want it to make it unique. You want to make it something that's special, that's driven specifically for what you're trying to do. And that's what we do with non-qualified plans or supplemental programs, is fit that niche. Talking a little bit more about it as well, and, you know, why should insurance professionals be interested in this as well? Because in most cases, these plans are informally funded with life insurance. Life insurance is one of the most efficient means for companies to set aside funds to be able to provide these types of benefits. So when we're working with organizations, it's not just to put in a plan as well, but it's to be able to put in a well-established plan that both the employer and the employee can feel comfortable that they're going to have a benefit for. So when we do that, we go through benefit studies, we go through funding studies, we go through all these different scenarios to make sure that all parties feel comfortable with what they want to be able to do. And that's what this slide is just simply showing, is a little bit about how are plans funded. Before we get into a plan itself, we really want to kind of talk about the main ways of how plans are funded. And a lot of individuals, companies decide to use mutual funds. Other organizations decide to use life insurance. And that usually boils down to the taxability of the organization that's putting in the benefit plan. If they're, if they've got a high tax rate, life insurance works perfectly because of the tax arbitrage that we can obtain through life insurance, especially properly designed life insurance. So when we're helping corporations put plans in place, let's say a scenario where a person has, $50,000 that they want to allocate into a plan. Well, they want to put that $50,000 somewhere. And if we put $50,000 into life insurance, a corporation wants to make sure that it has as much of that $50,000 available at all times. So properly designed with the right products, we can give them an asset that offsets their liability. 50,000 of liability, 50,000 going into the insurance, a $50,000 asset. So those are all types of things that we help you and your clients be able to design and put together. Going into a little bit more about defined benefit plans themselves, when we start looking, in some of these items, this kind of describes the plan that I want to talk about. So a defined benefit plan is essentially a non-qualified plan that acts, looks, and feels like a traditional pension plan. So if you think about that in that line, really what a pension plan does is makes a promise to your key employee. But in this case, it's a non-qualified plan, meaning we aren't subject to all of the rules and limitations of risk. So we've got some freedoms of what we want to be able to do. So if you can think it, we can build it. So a lot of cases when organizations come to us, their viewpoint is, hey, I want to give a special bonus 20 years from now. I want to give a special bonus 10 years from now. I want to make a promise of an income from retirement at age 65 to age 80. I want to do all these unique different things. Well, that's really what a defined benefit plan allows you to do. So if your client says, I want to give somebody a unique amount of funds to basically entice them and reward them for a job well done, a defined benefit plan will do it. Giving you an example of really how we've utilized this, and really in the last 2-3 years, since we've kind of come out of the COVID years, as we call them, a lot of corporations really want to keep key talent. So their viewpoint is we've brought in key talent, we want to keep key talent. Well, this is a situation where a second generation company, family owned, started by two brothers, ultimately moved into the next generations with a bunch of cousins, brothers and sisters, all working together. But that was the executive team, a family-owned business. Problem is the next generation had no interest in the business at all. Everybody liked the income that the business was providing these various families. And the third generation benefited from it because their parents were able to provide them a lifestyle that they couldn't get elsewhere. But unfortunately, they had no desire to join the company or run the company to the next level. So the company had a serious issue. What was going to happen when the next generation did not come in and the current generation wanted to retire, move on, enjoy some of the value of the business that they've grown? So the thought process was, hey, let's look to an outside person to manage the company on our behalf, ultimately allowing the family to keep and maintain the growth of the company and all the income from the company, but hire a professional manager to run it for them. So this is a very common situation. The problem that runs into is that when you have a qualified candidate, they run into a lot of fears with family-owned businesses. So in this case, the business was looking at about a 10-year time period when the senior person was going to ultimately retire to hand over the reins. Well, asking somebody to come into a business and wait 10 years to be the CEO to run the business is a big ask. There's a lot of fears for the individuals. Sometimes corporations don't want to provide enough upfront compensation because they're looking for someone who's going to grow into the business and pay them in the future. So if you go to somebody and tell them, I'm going to give you just enough, and I'll give you a lot later on, there's a lot of, well, what ifs, and those what ifs, what happens if another family member comes in and the family decides to swoop and let that person be the CEO and I get pushed aside? What happens if the company just decides to sell the business? And I basically put my career, or 10 years of my career, into this company and end up with nothing. So a defined benefit plan can be established to be able to provide methodologies of being able to help an outside executive be comfortable while at the same time meet the needs of the corporation. So what we ultimately did in this case is they found an outside executive, an individual who was age 38, relatively young, but in 10 years, that person would have a wherewithal of learning the business. And they thought about it as almost kind of a junior family member coming in. They wanted somebody that they ultimately could trust and to grow with, that ultimately would run it. So initially, their thought process was they give them a start out about $200,000. Well, the person with thought process was $200,000 wasn't enough, eventually to be able to do it. But what we came back with is ultimately we were going to provide 50% of this person's salary at age 45, 50, 55, 60, and 65 as stay bonuses. And as his career progressed, as his income progressed, every 5 years, they could relook at it. And if he wanted to leave, he could leave. If he was performing well, they would pay him a significant amount of salary plus these bonuses. So the incentive was there. It was equal on both parties. We incorporated vesting structures so that way, if in the first 7 years he left, he got nothing. He had to wait to be able to get his reward. But if in the interim he died or became disabled, or the family did what he feared, which is sell the business, he'd be made whole for the whole benefit. So basically, he was going to be rewarded no matter what. And the other key thing was that at age 45, he would be part of the team that would start finding all the other outside executives. So he could assemble his own team and have total control and basically be a good steward for the business. Now, funding. Now, the plan's put in place, but the question really becomes what happens? So when we talk about funding and the interest of why life insurance works perfectly for defined benefit plans or any other non-qualified plan is when we looked at a study, we wanted to try to figure out what was going to be the cost of the benefit. So ultimately make an assumption that maybe he wasn't going to ever get a large salary increase, looking at the worst case in his mindset. And also knowing that if the company was going to fund, they wanted to be able to protect that asset. They didn't want risk. They didn't want to set aside money for fear of losing that money. So ultimately, going through various funding studies, we looked at mutual funds, we looked at variable products, we looked at index contracts, UL whole life, the whole gamut in regards. The client ultimately settled on an IUL contract or index universal life. And what we ended up using was the sinking fund, the amount of money that they had to mentally set aside as our budget. And that bought us about $950,000 of life insurance. And if we assumed a 5% index crediting rate, and that all of the distributions, the payments at 45, 50, 55, 60, and so on, were going to be pulled out of this distribution or out of this product. We wanted to make sure we had sufficient money in hand to not only be able to take care of the premium, the benefit, but also recover the cost of the plan. So when we take a look at it, ultimately the cash flow of the benefit plan in this worst case was about $800 and some thousand. When the benefit is paid, the company would get a deduction of $260 some thousand, basically because it's future compensation. A deduction occurs when the participant receives their funds. So really, they were putting together a plan on an after-tax basis was about $550,000. When we incorporated the life insurance, again, premiums paid, distributions taken to pay benefits, and ultimately the death benefit assumed at age 85, that ultimately created a cash flow of life insurance coming back to the company of about 1.6, almost 1.7 million bucks. So at the end of the day, the company used this sinking fund, and if everything followed the pattern or the path, they would actually receive an additional 1.1 million of additional income coming from this benefit plan. So at the end of the day, what that does is that 1.1 million, that bottom line number there, gives us some additional flexibility, as if his salary grows up, we ultimately can give him a significantly bigger benefit and still be fully funded. That's the beauty of looking at life insurance, as a corporation has not only a good sinking fund, a tax qualified vehicle or a tax efficient vehicle to do it, but we also have a means of being able to recover all of our costs and have some profitability. So at the end of the day, the client chose to do funding, the plan's in place, all parties seem to be happy, but the only thing I guarantee is things will change. And what our role is to every year review this plan, take a look at it, find out what's changed and make corrections or make changes. Now, that's again where we also come in place. So not only do we have experience working with a variety of different types of companies as listed here, from ag business, from, restaurant groups to car dealerships, engineering firms, financial institutions, but in working with all these variety of businesses, we also then turn around and being able to help and provide you work through with the client's CPA, their attorneys, everything else that's necessary to put a plan in place to have all parties comfortable. So at the end of the day, we help you do the plan design, the financial analysis. We document the plan. We've got the documentations for the corporation. We help with financing, implementation, and then we review. So as quick as I could and as fast as the time period in today's brew, that gives you a good example of what could happen, why it's important to put in a good quality plan, as well as partner with an organization ourselves. John, any questions from yourself or anybody else that might be out there? Feel free to put them out there.
Yes, let's thank you, Dave, for that information. It's a lot to digest. I think it's really important. And as you say, I think this is something that many advisors encounter with many of their clients. There's a lot of moving parts there. I would remind everybody that we do have the chat box available if there's anybody who would like to ask any questions of Dave. And also to remind you that the attendees who are here are in a drawing for the CE voucher and a gift card, and we'll be announcing the winner in just a moment here. A couple of questions that come to my mind is as you look at that, there's a lot of technical detail that's involved in creating something like this. And I'm thinking that many of our audience on the brew who tend to be, more financial advisors, financial planners, retirement planners may not have the depth of experience to feel comfortable even bringing up something like this. How does the conversation typically begin between an advisor and his client to get something like this going before it even turns over to a company like yours?
No. I mean, the main question is always asking your client, your corporate clients on, what roadblocks, what issues are you running with your executive team, your rainmakers, your key folks, or even yourself as ownership? What is occurring? And then to asking the simple question, we used to call these plans napkin plans, and they were napkin plans for a reason, because if you could ask the question of your client, if you could put a plan in place, if you could fix this yourself, what would that fix look like? And typically people would indicate, well, I'd love to give a $50,000 bonus to this guy, a $25,000 bonus to this girl, but I don't want to just give it to them. I want them to I want that carrot out there. I want to wait for a few years. I want it to be a big reward that they're going to do a good job. So just like any other form of planning, you ask that question, what would you want to have happen? If you could write a plan on a napkin, what were the 3 or 4 things you'd like to have? Well, that's it. Those are the 3 or 4 things that we really would then help focus on. And just like any other form of financial planning, once you know the issue and you know an idea of what the owner wants to be able to do, then that's where we come in, working with the producer, working with the financial advisor, of saying, hey, I've got a client that's got these issues, and here's what he or she wishes to do. Is this something that we can accommodate? And that's when we start working with the producer to kind of give them a general idea of here's the follow-up, here's how we can help, and here's what the solutions are.
Yeah. Now, these are the plan that you described, or the example that you described. This works really well within privately held corporations. Is that correct?
Correct. They work for companies of all types. So there is
Okay, for all types.
no limitation in regards to what we're able to do as far as entity structure.
And you showed on a previous slide some of the kinds of businesses that something like this might actually work out well for. And I'm sure anybody participating today can look through this and probably find their own clients among that list. Is there any other thing that is really important in terms of the way that those companies operate? Do they need to be kinds of businesses that have a lot of cash on hand, or can this really be any kind of company?
It truly can be any kind of company. I mean, cash on hand obviously helps with the funding decision. I mean, if you want to promise somebody a benefit, you better have the funds to be able to pay for the benefit. So, you know, we can handle with wishes, but we can't handle that kind of wish if they're not profitable. But yeah, they first need to have some key people. And it's not just having key people they care about. I mean, there's a lot of businesses out there and business owners that really just don't care about their key people. They view them as any other commodity. But a good, successful business has a good team of key people around them. That's one item that we really want to focus on. They want to be able to do something. They just don't know what.
Yeah.
The other part, just to give you an idea as well, is when you're talking with your client or then engaging with us, finding out what type of entity they are. I mean, LLC, S Corp, C Corp, that is specific in regards to the tax rules, deductibility, and structures. You need to know that basic question, because if you don't, we could go down a path that's completely different than what's really needed for that type of client.
Very good. Thank you, Dave, so much for that information. While we're waiting to see if there are any final questions, I'd like to remind you that today's brew and our full library of brewcasts are recorded and shared on the Brew blog on our website at www.e4.insurance, and also on our YouTube channel. Just Google YouTube E4 Insurance Services and you'll see the entire library. Now, it doesn't seem that there are any other questions in the meeting chat. So for our giveaway, Dave, if you would you pick a number between 1 and 25?
22.
The number is 22, and our winner today is Daniel Flea. So Daniel, congratulations, and be on the lookout for a complimentary CE voucher and a Starbucks gift card from us at E4. I did see another quick question that came up from one of our attendees today. And could you put your contact information up on the screen one more time so that people know how to be able to reach out to you, Dave?
Oh, yeah, I think I do. Let's hope we have it on there. There we go.
Now, we'd also like to remind you that next week we will be welcoming E4 Insurance's very own managing partners, Daniel Peterson and Brendan DeRoan. Dan and Brendan will be joining the brew for our first huddle up of the year, reviewing 2023's Q1 results at E4 Insurance Services and some of the current industry trends, as well as answering questions from the attendees. So Dave, once again, thank you so much for being here. We really do appreciate your expertise and look forward to having you in the future again on the brew. And for everybody who's here today, thank you for attending, and we will see you next week here on the brew.